Tanner UNF Corporation acquired as a long-term investments $240 million of 6% bonds dated July 1st on July 1st, 2018. Company management has the positive intent and ability to hold the bonds until maturity. So this is the key information to categorize this investment in bonds as held-to-maturity security, which means we do not report them as at the fair value. We report these bonds at amortized cost. The market interest rate yield was 8% for bonds of similar risk and maturity. So we are going to use this market rate 8% to calculate interest revenue for these bonds for Tanner UNF. Tanner UNF paid $200 million for these bonds. So this $200 million will be the starting outstanding balance for the investment in these bonds. The company will receive interest semi-annually on June 30th and December 31st. Semi-annual means we will use 4% instead of 8% to calculate effective interest. As a result of changing market conditions, the fair value of the bonds at December 31st, 2018 was $210 million. Because we hold these bonds until it matures, positive intent and ability to hold these bonds until maturity, the fair value at the end of 2018, $210 million is not relevant. Okay, so number 1 and number 2 asks us to prepare journal entries to record the purchase of these bonds and interest received at the end of the year. The interest will take amortization table since they didn't tell us they use straight line method to account for interest. So pull up an Excel sheet to do amortization table. Date, cash column, effective interest column, div column, outstanding balance column. They first purchased these bonds on July 1st, 2018. Outstanding balance is the amount they pay for the bonds. So $200 million. Interest will be paid on this June 30th and December 31st. So the next payment day after July 1st will be December 31st, 2018. Cash interest is calculated by stated rate. Stated rate here 6%, but semi-annually, so only 3%, multiplied by the face value of the bonds, $240 million. Effective interest will be based on market rate 8%, but semi-annual rate should be 4% only, multiplied by previous balance. And the difference is the larger minus the smaller. And since the amount Tanner UNF paid is smaller than the face value of the bonds, these bonds were issued at discount. So later we are going to see the balance goes to face amount $240 million. So we should increase the balance. The previous balance plus the difference. So with these two lines, we can do journal entries. First, the purchase of these bonds is an investment. So we debit investment in bonds at face value $240 million. On the credit side, we pay cash, so we credit cash of $200 million. The difference is either discount or premium, and we follow the name of issuer. Issuer issued these bonds at discount. So we will balance this entry on the credit side with a discount on bond investments. The difference is $40 million. And then when we receive interest from the bond issuers, we will record these three amounts. Cash received is $7.2 million. And then we have interest revenue. Based on the table, we have $8 million. The difference is $0.8 million on the debit side, and that is the amortized discount. Okay, and then requirement 3 asks us what amount should Tanner UNF report for this investment at the end of 2018. These investments are held to mature, so we will report its amortized cost on the book. So that will be $200.8 million. Requirement 4 says, suppose Moody's bond rating agency downgraded the risk rating of the bonds, motivating Tanner to sell the investment on January 2nd, 2019 for $190 million. Prepare the journal entry to record the sale. This is held to maturity securities, so we simply mirror the entry of issuer, and we learned early extinguishment of bonds in chapter 14. And I believe at that time, I also show you the investor's journal entry. So we sold the investment, we received cash. And we sold it for $190 million. So $190 million is the cash we received. And then we need to get rid of this, the book value of these investments. Book value of bonds has two components. The face value of the bonds is called investment in bonds. So we credit investment in bonds at face value of these bonds, $240 million. When we first purchased these bonds were issued at discount. So there were discounts in bond investments on the credit side. Now I need to retire these credit accounts of discounts. So we move them to debit. The account name is called Discount on Bond Investments. And the amount will be the unamortized discounts. Initially, when the bonds were purchased, there were discounts on bond investment of $40 million. It's from It's calculated from the face value of the bonds and the cash we paid to buy the bonds. So here $40 million of total discounts at issuance. And after 6 months, we have amortized $0.8 million of discounts. So $40 million of total discounts minus $0.8 million of discount being amortized. The unamortized discounts now is only $39.2 million. So we are going to retire $39.2 million of discounts on bond investments. So by these two amounts, we retire the book value of these investments, of these bonds. And then the last step is to balance the entry with either the gain or loss. On the debit side right now, we have $229.2 million. On the credit side, we have $240 million. So we need to balance the entry with a debit. When it's a debit, it's called a loss. Loss on sale of investments. To balance the entry, I need $10.8 million.